Since 2015, Turkey has experienced one of the most persistent and most highest inflation rates of the whole world. To understand this or to put this into perspective, on the heat of the crisis, they had between 80 and 100% inflation rate per year, changing the lives of everyday people, of millions of Turks in those years. So we want to explain in this video how this happened. And to understand that better, we have to understand the economic policies and the loss of trust in Turkey. Like before 2015, Turkey looked actually quite stable. Like they had inflation rates around 5 to 6% per year, and they had continuously growth rates, but the economy was highly dependent on foreign investments and foreign resources. So as long as the foreign capital was flowing in and the trust of the foreign investors were there, the currency and the country did well. But in 2015, a political crisis reshaped the whole economy. In 2015, political crisis started to unfold in Turkey. Like the power of the government became increasingly centralized around the president Erdogan, and around this was a lot of controversy. And then a failed coup attempt started to reshape the country. So there were mass deportations, there were a lot of protests, there were military rolling in the main capital city. So the trust was shook and a lot of investors fled the country, so that the currency in a short period of time for the first time lost a lot of value, and inflation rates for the first time reached over 10% per year. In 2017, then, this whole process came to even more difficulties because President Erdogan then changed the central bank policies and the economic policies of the country very drastically. So he started to say that high inflation rates are even triggering inflation, which is against the common economic belief. Because if you think about it, if you have a high inflation rate, the interest rates should be even higher. Because if you have 10% inflation rate and you have 10% interest rates, you're losing no money. But if you have like 5% inflation rate and only 2.5% interest rates, you lose 2.5% per year for just holding the currency. So the interest rates should always be higher than the inflation rates. But Erdogan explicitly ordered the central bank to hold the interest rates low because he thought it would grow the economy and outgrow the inflation over time. But this didn't happen. The Turkish lira lost in 2017 and 18 over 40% of its value, and the inflation really started to get growing. In 2019, first, it looked like the country would stabilize again a little bit and the inflation also came down. But then the COVID crisis hit. And as the whole world was hit by an economic crisis, so was Turkey. And the government answered with government spending, with credit expansion, and with printing a lot of money. So the inflation problem was back at an even higher level than before. Now between 2021 and 2023, really the inflation rates started to escalate. So the central bank even lowered the interest rates even more. So the inflation went through the roof, like everyday prices exploded, rent prices exploded, real estate prices exploded because people wanted to get out of the Turkish lira as soon and as quick as possible. Erdogan's government also took a lot of countermeasures. You weren't allowed to hold gold, to hold US dollars, to buy foreign stocks or anything where you could flee the country or flee the capital in Turkish lira. So this escalated the situation even more. And we hit those high inflation rates of 80 to 100% per year inflation rates. And the people just started feeling it heavily that their money was not safe anymore. And they lost a lot of value. After the re-election of Erdogan in 2023, the government signaled a shift in their policy. Also, a new team of economic advisors was appointed, and finally, the low interest rate policy was abolished. And that's also met an international trend, like the Federal also had kept the interest rates quite low after the financial crisis of 2007. But finally, after COVID, also in the United States, the inflation rate rose over 7-8%. So they also rose the interest rates. And so Turkey was pressured to do it also, because if they didn't want it hyperinflation like in other countries with over 200% per year, they had to change their policies. They sharply raised their interest rates over 20% per year, but that's still like only a recovery mode, because the inflation is still around 30-40% per year. So if your inflation rate is still times 2 your interest rates, you still will have a struggling currency. The currency is still weak, foreign investments are still weak, and the trust also of foreign investors will be destroyed for a longer time frame. So Turkey really struggles from that. But what we offer at Swisscoin is that you can invest in a stable coin which is based and pegged to the Swiss franc, the currency of Switzerland. Check it out in our bio for more information, or check out the other videos on our channel where we will inform you about those opportunities.